Hello guys, welcome back to another lumpy trading video. In this one we're going to be doing some in-depth stock analysis on JSPR, which is today's largest gap of being up just a little over 100% on the day. We have had quite a few large gappers today, which is good to see that stocks are starting to kind of pick up a bit more. It's been slow the last few months, but as we're coming into the winter months, it seems to be that volume and gappers are starting to pick up again. So to get straight into it, firstly, as always, we go onto the daily chart, see is there any gaps that need to be filled or any obvious gaps that need to be filled, and looking at it kind of right away, we could kind of see there was a gap fill to be done at 15.14 and a new gap created down at 7.11. So we can actually get the exact value on that, as that seems like it will, it's not super accurate. So actually at 12, okay, it didn't make much of a difference. And then what we always do is go over the standard deviations and plot those lines. The reason we want the standard deviation lines is we can start seeing if it's overbought or overbought, and how it's going to trade, because what you'll notice with this JSPR is that it's closed above this fourth deviation. So closed above the fourth deviation on both the 4-hour and the daily. So you can see obviously this 15, it closed at 14.79, and the fourth deviation on the 4-hour 180-day chart is at 14.73. So you can see it kind of closed a little bit above. But this tells us one thing in particular, is that this stock is going to be a very risky one to trade. So depending on how you trade, it may mean that you don't trade it at all. Like personally with me, so a stock like this, I personally would not be trading, because when a stock closes above that fourth deviation, it is considered very, very oversold. But what you also see with stocks that close above the fourth deviation is that then they no longer react as normal. You do get that occasional, so you can think of it as standard deviation, where you go, as we always say, within the golden deviations you have 68% of the data. Within the blue deviations, which is second, you have 95. Within the green, which is the third, you have 99.7. So for stocks to trade outside of the green is very rare, but when they do and they close outside of there, they tend to react very strange, and it's kind of a lot harder to predict, for the reason being that they're just trading at an extreme, and if something's that extreme, there's no saying that more hype and more buyers coming in can't make it go even more extreme. You saw it with AMC and you saw it with GameStop. So it is a big thing when you do see a stock like this. Be very cautious depending on how you trade. If you're day trading, then it may not apply as much, but if you are swinging, then definitely be careful. So and you can also think about it as well with stocks, is yes, the stock or the data within the stock should be within those data bands all the time, but it also means that you have 99.7% of the stocks will be within their green deviations, and then you have that 0.3% which are outside of those. And when those stocks are outside of that green deviation, it's just a very unnecessary risk to be trading it. You could just go to the next stock down, let's say for example a ORPH, it's trading within its deviation band and would be a lot less risky. Same on RDW. It's a lot safer to be trading these kind of stocks because they're not closing outside of the fourth deviation. When you see that, again, it's very extreme. So you just kind of want to raise the risk factor on trading something like that. But as we can see, intraday it came into these deviation levels, and you see it had reactions to the most part. But one thing you will notice is it broke, or it filled its gap, did its pullback, and then broke out of it. Usually when you see this, is that it is a sign that it will continue up for the day, and that's what you kind of saw. It broke from $15 and pushed to a high of 18. That wouldn't be the most crazy thing. If you're watching that in person, you see that gap get filled, you see it kind of break that fourth deviation, come back, test it, and still get buying pressure, and that's usually an indication that it will stay strong on that day. And now one thing we are seeing is that the market at the end of the day did try to push back and close within the fourth deviation, but just slightly failed by that. So that is just one thing, again, to be keeping an eye out tomorrow, because when a stock does that, it is trading in an extreme. So for targets, we can't really give any upside targets. All we can say is that currently we have a high of $21. This was created back in September. And as the stock has closed outside the fourth deviation or even third deviation, it's not unlikely that it can't continue and break to that high. So to the upside, I guess our key target would kind of be that $21, because it wouldn't be unlikely for it to break back up to the original high. The only thing that would raise a bit of concern is how far it has to move. When it made that original move, it was going from $10, so really it only made a little over 100% altogether. But as the stock closed around, or did close at 722, for it to get back to that $20 move is a lot more of an extreme. And that's why, yes, we've made a high today of 1820 or 1820, roughly around there. It could quite easily be the overall top, because I mean, just like anything, you could quite easily just draw that line and see that it's still an overall downtrend. But obviously when something's trading in extreme like this, it's hard to really say, and that's why I've kind of done more of these levels. Is they're more just levels to be keeping an eye on. We can't really give targets to the upside. $21 will be a key level, and you probably do want to be looking at it. Not saying you should get short or that you should get long, but it will be in an area where a reaction would happen if it pushes higher tomorrow. But apart from that, if you're looking maybe to trade it to the downside, these are levels that we would be looking out for. That gap's now been filled, so we can ignore that level and instead be looking at these. So the 1475, 1350, 1280, 1250, 1210, 1150 to 1130, and then 1075 are all levels where we will most likely see a reaction at. So if you're just looking to trade it to the downside or waiting for levels to the downside, these are most likely areas where we will get small bounces, and maybe even a reversal. For example, if it breaks down, let's say JSPR opens up weak, opening up around 1350 or 1280, then it wouldn't be unlikely for it to kind of push down to one of these deviation levels before getting a bounce off and maybe to an all-time high. So basically, kind of in a summary, it's not like when we're looking at large cap stocks we can give predictions on where the price is going to go, where our low risk buy entries are, where profit targets are. On these kind of stocks it's a lot harder. So instead what we can do is say these are our price levels, and depending on how you trade, you can utilize these levels different. If you're looking for small bounces, then these levels, you would be looking for a small bounce off each of these levels. If you're looking for pullbacks to follow the trend, if this is gapping down and you're looking to follow the downtrend, for example, if it breaks down below 1356, goes down to, let's say, $13, pulls back a bit and retests this 1356, then that could be a good level to be getting short. But again, it all depends on how you trade. So we give you these levels, so you know these are the levels where there will most likely be a reaction, and depending on how you trade, you can utilize these levels in different ways. So I hope you enjoyed the breakdown on JSPR. If you have any stocks that you want analyzed, usually we do it on a large cap stock, but if you want any small cap stocks analyzed, just let me know in the comments and we'll get to it. Peace.